Welcome to the What to Watch video update. Every week I do a number of different videos, and the last video I do over the weekend is I pick out the slides that I'm really focused on and look at those charts. I have a positive side, I have a negative side, and then another area where I'm just watching some things because we want to see, are they going to turn things more negative or turn things more positive? This is being prepared for Monday, January 6th. The first area are the positive things. When we look at an intraday chart of growth versus value, we see that the blue line is above the red line, and that's what we want in a good positive environment. Now, it's been getting hit lately, but so has value, the red line. But for the most part, growth has been holding up here. Even though they're on different scales, we like it when the blue line is above the red line as it is now. So this could be under the surface, but we've been seeing this for a while, and it hasn't led through into any significant price action. We're going to lose this if we don't see a lot of buying coming in pretty quick. Now, we're hoping that volume will pick up now that the holidays are over. Smart money's coming back. The market will be closed on Thursday for the state funeral for President Carter. But other than that, folks should be back trying to buy and sell, and hopefully volume will follow through by picking up. We're also looking pretty good here. Going back to the last part of November, the growth to value ratio intraday for the S&P has been doing well. Even when we've been under some pressure lately, this is still continuing to go sideways. So this is holding together for the time being. We look at an end of day chart of growth versus value. This is also giving us a very high reading, showing that growth is outperforming, and that is more positive. Another positive thing is that discretionary is outperforming staples. Now, staples have been under pressure lately, and I have a chart later to show you of that. Even though discretionary has been pulling back, when you compare the two, discretionary is still outperforming, and that is more positive. The small caps, okay, there have been real big hope that they were going to go up. Well, look at the index. It's been going down and then going sideways. But if you look under the surface, we're still seeing a positive growth to value ratio here. We also haven't been going anywhere with the mid caps, but the growth to value ratio is positive. The S&P growth to value ratio remains positive. It's in an uptrend. If this could continue to go up, that would be more positive for the S&P. We look at some growth to value ratios. Now, these have been getting hit a bit here. We were seeing the Qs to S&P really doing well. Now they're coming back down to their moving average. When we look at discretionary to the S&P, we're actually under the moving average. We need to get back above that. And when we compare large cap growth to large cap value, we're coming down to the moving average, but we have been bouncing up a little bit. We look at the large caps, which I just said are bouncing up off the moving average. The mid caps crossing back above the moving average, as are the small caps. So there are some positive things under the surface. We just need to see it translated over into price action. Large cap growth has been holding up. It came down to its 50-day moving average and so far has been holding up above that. Now we're below the 50-day moving average with the S&P, but we're still above the moving average with the large caps, the Nasdaq and Nasdaq 100. And those are support levels that we'll be watching that I'll go over in just a moment here. We're still above the 100-day moving averages, both the simple and exponential version for the S&P. As long as we stay above that, this remains positive. Accumulation distribution. You kind of have to get a magnifying glass here, but we're just barely going up above the moving average. This is a smart money indicator. It uses price and volume to, excuse me, to calculate, and it is improving a little bit, but we've been flatlining for the most part. We need to see this continue to go up, but it's on the positive side since it's slightly above its moving average. And we were looking better here with the Chaikin oscillator. Then we started to fall back. Well, after Friday's upward move, we're starting to go back up again. I have three smart money indicators that I follow. The first one was accumulation distribution, which is slightly positive. The second one is here, the Chaikin oscillator. That's turning back up a bit. Then there's another one later that's actually not looking so good. We look at a 10-day simple moving average of the advancers minus the decliners for the S&P, and we're finally crossing back above zero. So this is showing some improvement here. When we look at the stocks versus bonds and then do a ratio between the two, we're coming back up. We're still at the high end of this rainbow, and this is that the market is anticipating a soft landing. Now, if we do start to really see recessionary signs, we'll probably see this ratio go down. Even though it's been pulling back lately, it's still holding up for the most part. A long-term look at the trend, we're still at the high end of the rainbow. We came down into it and we're still in the rainbow. If we could get back up out of the rainbow, that would keep these lines going up and to the right, and that would be longer term positive. We're keeping an eye on the VIX. Now, the reason this is positive is because we're still under 20. We're still at a high level, though. We did come down a bit in Friday's session with the update. We're back down below the moving averages here with the line chart as well as the bar chart. And then if you look at this over a period of time, when the VIX is over 20, that's when we see positive annualized returns. And this is a study that was developed about a year ago by Tom Bowley, who works with stockcharts.com and earningsbeats.com. It's when we get above 20, that's when we see negative annualized returns. Now, we want the VIX to go down. That would be more positive. We closed at 16.13, coming down a little bit with Friday's advance, but we want this to continue to fall. The more it falls, you can see that the annualized returns end up going up substantially here. And this is more of a broad market measure. This is the NYSE McClellan oscillator. Now, I'm going to show you in a moment the S&P McClellan oscillator is still below zero. But here, the NYSE McClellan oscillator has now crossed back above zero. So that's showing some broader market potential improvement. And when this goes above zero, it's really hard to see, but we're starting to turn up with the summation index based on price and volume. We need to see more follow through with this to see if there's something really developing here. But there is an improvement, at least as of right now. And then we look at the total US stock ETF. We're coming back up to the 50-day moving average. If we can get back above that, that's why this is positive, since we got back up to the 50-day moving average. But we need to go above it and stay above it for this to remain positive. The financial sector also coming close to its 50-day moving average and still in a longer term uptrend. We want the financial sector to do well. And if it does well and tech does well and discretionary does well, communication does well, then the market does well. We keep an eye on the FANG index. These are really big companies: Facebook, Apple, Amazon, Netflix, Google. Even though it's been coming down a bit here and even going sideways, we're still well above the 50-period moving average and in a longer-term uptrend. This is the NASDAQ, where we're bouncing off of the 50-day moving average. This is held so far, and this could be positive. It doesn't mean that we're necessarily going to hit support in the S&P if that ends up happening. We could hit it in another index. Well, we're keeping an eye on the NASDAQ because it's bouncing up from the 50-day moving average and slightly above the new pivot level that was drawn for January. And we're also still above the 50-day moving average and right at the pivot point here with the NASDAQ 100. If that could continue to go up, the stocks that are in the NASDAQ 100 are also in the S&P 500, and that could help the index. This is another thing that's positive. We were able to stay above the 50-period moving average with the QQQs, which is the ETF for the NASDAQ 100. It would be even more positive if we could get back above the 20-period moving average. That's short term. But this is holding up better for right now, and that could give some support to the market. Of course, if we fall back down, that's going to turn things more negative. High leverage loans, another barometer of the economy. Even though we've been under pressure here, we really haven't been coming down with this ETF. This is still looking pretty solid. And then we look at the tech sector and compare it with 3 to 7 year bonds. Even though we've been chopping sideways and we're in the rainbow, at least we're at the top end of the rainbow. If we could continue to go up, that would be much more positive. Longer term, the S&P going back to 1987 with the weekly chart here, we're still in a longer term uptrend, looking good there. The NASDAQ weekly chart, NASDAQ 100 weekly chart is still above this long-term trend line going back to 2009. We look at a ratio between growth, which is the NASDAQ 100, and Dow, which is considered to be the best of the best stocks. And when this ratio is going up, that means growth is really outperforming, and we're seeing that ratio continuing to go up. We also look at the NASDAQ 100 and compare it to the small caps, also showing that the bigger stocks are holding up better with this ratio. We look at a ratio between the Qs, the NASDAQ 100 and 3 to 7 year bonds. We're still in the rainbow, but we're bouncing back up. If we can get back up out of the rainbow, that would be more positive here. Then we look at the negative side, and this is the daily chart. The reason why I have it on the negative side is we're still below the 50-day moving average. We need to get back above that. Many times through this past week, that was the high for the day. We just can't seem to get above that level. On the bottom, we've been really below average with volume. That hopefully should pick up in the upcoming week. The short-term trend is negative, though. We are seeing that the ADX, that's the black line, it's above its moving average and it's above 20. This means that yes, we are trending. Yes, the trend is getting stronger, and it's negative because the red line's above the green line. Now, with Friday's upward move, we are coming down with the red line. We're trying to go up a little bit here with the green line, but for right now, in the short term, this confirms that the trend is negative. We're also negative in the intermediate term. The ADX is above the moving average, the red line's above the green line, and they're both above 20. We want to be careful of this. This is suggesting a negative intermediate term trend. Volume is below average, and that's usually considered a negative thing, especially when we try to go up. It's can be climactic when we're going down and we see a real surge in volume. Keeping an eye on sentiment where we are at a really low level. Now, we did bounce back up a little bit here, but we're getting a very low reading overall. It would turn back to positive if we could climb back above 50. We also watch the direction of this as well. If it's going up, that's more positive. If it's going down, that's more negative. And we were pretty much on top of the moving average when we look at the VIX. And I use the MACD to try to measure the momentum of the VIX. Is it going up or is it going down? We were starting to come down here as the VIX was coming down. We didn't see a cross here with the MACD. And now, even though the VIX fell on Friday, we're right back down on top of the moving average. So there's not a lot of conviction showing here. And since the MACD is just a little bit above the moving average, I decided to put that over on the negative side. The condition of the short-term trend is measured by 20 periods. We're below the blue line and the green line, and these lines are continuing to go down. We need to get back above these lines for that to turn more positive. This is a simple and exponential moving average based on 20 periods. We're below both, and these are starting to roll over the longer we stay below these lines. Then we look at the intermediate term trend. We're also below the blue line and the red line here. We need to get back above that to turn things more positive. And we're just right at the 50-day moving average now. You can see the last number of days. This marked the overhead resistance that we were seeing. It's going to be more positive if we can get back above this and continue to go up. Looking at all the moving averages, we're below the 20 and 50. We're still above the 100. And then a short-term rainbow where we're down below the rainbow here. This goes from 10 periods up to 50 periods. If we can get back up into the rainbow and get above it and see the lines start to go back up, that would mean the short-term trend is positive. Intermediate term, coming up into the high end of the rainbow here. We haven't been in here long enough to really see the lines start to roll over, but the longer we stay in here or continue to go down, these lines are going to really roll over and look more negative. And then the stocks inside the S&P above their 20-period moving averages, getting a very low reading. We're seeing some recovery here. We're actually not as extreme as we were, and we need to see this really bounce up. That would help the short-term trend. And we have a study that goes along with that, where after we get a low reading below 10, within a fairly short period of time, we want to see this go up to 70. That hasn't happened yet. We've been waiting for it now, but we'll just keep watching this to see if that does end up happening. And we're bouncing back up after being extreme with those stocks above their 50-period simple moving average inside the S&P. So it's improving, but still quite negative since we're below 50. Also improving with the 100-period moving average study. We never did go negative, at least yet, with the 200-period moving average study. We're still above 50. We're trying to bounce back up right now. This is longer term negative. We take the highs and lows for the S&P and then a 10-day average of that. This is below 50 and continuing to decline. The advanced decline line is still positive in the bigger picture since we're above the moving averages, but this just hasn't been performing all that well lately. It did come up a bit on Friday with the up move, both based on price and volume. We need to see more follow through upward action for this. And this is also negative. We're seeing, even with the update on Friday, where the new lows expanded and the new highs are contracting. And we're still going down with our 5-day, and we're trying to bottom out here with the 10-day. If we could turn back up with these and show more green than red, that would mean internally the S&P is turning more positive. If the red continues to dominate, that's going to keep these lines going down and be more negative. Excuse me. The advanced decline ratio. Short term is based on 19 periods, intermediate term is 39 periods. We are bouncing back up, but we're still below zero. This is the third smart money indicator. And even with Friday's upward move, this is continuing to go down and the red line's going down. So this is negative. So the accumulation distribution, you could lean positive. The Chaikin oscillator showing a little bit of improvement since it's turning back up, but the Chaikin money flow is going down. So we're not getting a real consensus there. We're negative with the vortex. The red line is above the green line. Now, if the green line can continue to go up and the red line go down and these lines cross, that would be more positive. Not happening yet. We're going to be watching for that. And this is the S&P McClellan oscillator, where it did improve in Friday's session, but we're still below zero. So when this is below zero, we're still declining with the summation index based on price and volume. We might be trying to turn up a little bit here with volume. That's another thing we'll be watching because sometimes volume will lead price. We were negative with the Swenlin trading oscillator. We were going up even as the S&P was going down. Not now. It's below zero and we're still declining based on price. We're trying to flatten out here based on volume. We need this to turn back up to look more positive. And momentum. And the reason I'm showing this, I have this on a different chart that I'll show in just a moment. We are negative with the price momentum oscillator. And when you break it out based on price and volume, we're also negative. This is why I'm showing this, because we might be seeing some improvement. These are all of the PMOs inside of the S&P. And we're starting to go back up with the PMOs that are rising. So that could mean some strength is coming in. We're trying to turn up, but we're still extreme negative with the buy signals, but we're still declining when we look at the PMOs that are above zero. So getting a bit of a mixed picture, but possible improvement with this chart. This is the momentum. In the short, intermediate, and long term, we're still going down. And the daily chart of the parabolic SAR has now turned over negative. We have the dots on top. The weekly chart for the last 3 weeks now has had the dots on top. So in the daily version and in the weekly version, we are negative, and I consider this to be a primary indicator. And there's no ambiguity here. It's either positive or negative. There's no in between with this particular indicator that we use. We're still negative with the bullish percent index for the S&P. It bounced up a bit in Friday's session, but we're still below 50, and we need to get back above the moving average and start to go up with this indicator. And ticking up just a little bit, but still negative with the NYSE bullish percent index, and showing a bit more improvement and possibly some leadership here with the NASDAQ 100 bullish percent index. Now, if this can continue to go up and eventually cross above 50, that would be more positive. And then we look at the cumulative advanced decline line for the NYSE. We were up in Friday's session. We're back above the moving average. And we look at a regular NYSE advanced decline line. We are improving, but we're still below the moving average. And we look at the advanced decline line. Now we're seeing some improvement here, turning up after Friday, but we're still below the moving averages here. And the moving averages themselves are starting to roll over. So that's a concern to us. The Wilshire 5000, another broad market measure, trying to get back up to its 50-day moving average, but not quite there yet, even though we're still in a longer-term uptrend. The Dow, also in a longer-term uptrend, just kind of floundering around below its 50-day moving average. The momentum for the NASDAQ 100 is still negative, is measured by the PPO. Now, there's some other things that we're looking at for the NASDAQ 100 that are positive, but this one is negative. We need to see this turn and go up and cross back above its moving average. Small caps, not really going anywhere, at least yet, and they're still below their 50-day moving average. This is the S&P small cap index. We look at a ratio between small caps and the S&P, still continuing to underperform. And here's the Russell 2000 small cap index, also going sideways below its 50-day moving average. A little bit of an improvement with the RSI, but we're still seeing the momentum negative, even though we're trying to turn up here. Mid caps going sideways below their 50-day moving average. And this is a broad market measure of the highs minus the lows and taking a 5 period moving average of that. We are showing some improvement, but we're still below zero here. And this is what's causing a lot of problems. Rising interest rates. They were actually up in Friday's session, but they were down on the week. But if interest rates continue to go up, that's going to pressure stocks. Now, there are some things that we're looking at with bonds that may suggest, based on price, that we're hitting support. If we start to go up based on price, that will bring interest rates down. Of course, if we break through that support, that's going to turn things more negative. And this is also a bit of a concern. Home construction to 3 to 7 year bonds, we broke below this 250 period moving average that held previously. It has not held here, and we're looking more negative. And then this is actually positive when you look at the trend channel. We're at the high end of this, but this could be acting as overhead resistance. We got about up to this level, and that's when the S&P started to run into trouble. Now, at the end of 2021, yeah, we went above this, and we're seeing if we can go back and get above this again. That would suggest good momentum, but we're not seeing that right now. This is another thing, staples, which is a defensive area. When staples are doing well, they we get a little concerned because this may mean that the market is getting more defensive and getting ready to go down. Well, staples have been under pressure lately, but they are coming down to their 200-day moving average. So far, this level is holding. Now, even though this is more defensive, you can see throughout 2024, they've been in a really solid uptrend. They've been underperforming the S&P, but they're still in an uptrend when we look at them by themselves. If we can bounce up off of this, that could be considered positive because now it's going up. But we want to watch this. If this starts to outperform discretionary, then that could turn things more negative. And then other things that I'm watching, and I have some positive charts and negative charts to show you. I've been really honing in on the semiconductors lately. They're a huge part of the tech sector, and the tech sector is a huge part of the whole market. We also want to keep an eye on the financial sector as well. Now, you look at this, the SMH semiconductor ETF, we're in an uptrend and we're back above the 50-day moving average. But there's been a lot of sideways action lately. And we're coming up into the top end of the rainbow, actually peeking our head out a little bit here. But you can see these lines are jumbling up because we've been going sideways. And this is a new one. This is the Dow Jones Semiconductor Index. This is looking a little more positive. Longer term uptrend and the 50-day moving average held, and we're starting to go up. And we're seeing these previous levels here. If we can break out above this, that could be quite positive for the market. Now we look at the negative side. You look at the SOX index, which measures semiconductors, and we're in a downtrend. We're a little bit above the 50-day moving average, but we've not been able to get back above the 200-day moving average with this chart. So that's why this is leaning more negative. And the semi to tech ratio, we've been bouncing around. Now we bounced up on Friday, but we need to see some sustained move to the upside to turn this more positive. Now, earlier on in 2024, the semis were leading the market higher. Then we topped out over the summer, and this ratio was coming down, but the S&P was still going up. But since the large caps and the mega caps are really holding up better, that's why I'm honing in on this for the time being. We need to see this improve to turn back more positive. If this breaks down, that's going to be more negative. We look at a ratio of semiconductors to the Dow coming down off of this blue line here, even though it is improving a bit, it's not really falling the way it was. It would be more positive if this were to go back up. Then we want to keep an eye on weekly jobless claims. They really came down this past week. That's showing strength in the economy, and the 4-week moving average is starting to come down. We also dropped off with the continuing claims, and the moving average is going down. That's suggesting strength in the economy. And we want to keep an eye on the spread between risky and not as risky bonds. It's really hard to see from this chart, but we're starting to go back up here. That means fear is increasing when you measure the spread between the two. Now, this next chart in the middle area, this is an inversion of what we just saw and a little bit bigger. We've been really coming down. That means fear is increasing. We ticked up a little bit on Friday, but if this continues to fall, that would be more negative. If this can keep going up, that would be more positive. And the skew index, I have this on the watch list because I don't know. We have up days and this still gives us a high reading. We have down days, we still get a high reading. This is a variation of the VIX. where the VIX uses at the money options to be calculated. The skew index uses out of the money options, and the market is still expecting some kind of a big move. When that big move happens, either up or down, then we will drop down from this particular extreme reading. We want to keep an eye on the relationship going on in bonds here because the market's getting a little concerned about inflation and the Fed has upped their inflation forecast. The first chart here just shows where cash is outperforming 3 to 7 year bonds based on price. That's kind of strange that cash is actually doing better. But this means that there's an uncertain environment right now, and inflation might be coming back into the market based on this chart. But when we look at the next chart, tips, which adjust for inflation, when they're going up, that means there's inflation worries. When this is going down, usually inflation and interest rates are coming down. We're going down again here. So that's not confirming what we just saw on the previous chart. But when we look a little further out and we look at tips to 7 to 10 year bonds, this is going up. And this is showing that there's some inflation concerns. Then we want to keep an eye on a thing called the SWAG NYC breadth thrust. We came really far down here below this blue line. We crossed back above it, and now we need to get up to this red line. That would be a SWAG NYC breadth thrust. And that has to happen within 10 trading days after we cross back above this line. You can see other times when we had these breadth thrust signals and then what the S&P did after that, and it's quite positive. We don't know if this is going to work out, but we're just keeping an eye on this for right now. Oil is starting to go back up again. There's some geopolitical things going on that may be pushing oil back up. We just watch that right now, mostly for geopolitical reasons. And the dollar's been very strong, which is also pressuring stocks. We got up into the 109 range, but since then we've dropped into the high 108 range. But this is looking pretty solid on a trending basis. And I just watch this because there's sometimes when the dollar going up really impacts stocks and other times when it doesn't. And then we have this thing called the Hindenburg almond. And if you don't know what that is, there are three criteria that need to be met. We have not seen an additional spike here. We have the initial signal, and then we have the confirmation. And so we're just watching this for right now. We'll see if another spike ends up coming. Now, a lot of the perma bears, they see one spike and they say it's a done deal, we're going down. But they always say that. If we see a series of spikes here, like we did right before the COVID crash and right at the end of 2021, yeah, that could be a lot more negative. But we're not seeing that yet. And we do have a confirmation of this. So this will be on the books for about 30 days now that we've been confirmed with this. So we're just watching this. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.